Welcome back to Daily English Dive.
Hey, it is great to be back. And today we are tackling a subject that I think makes a lot of people get a little sweaty just thinking about it.
Oh, absolutely, I get sweaty. We are diving into a really fantastic three-part audio series hosted by Sophie and Jack, and the topic is the stock market.
Yeah, the big one.
Right. And I have to be honest with you right out of the gate. When I hear the phrase stock market, my brain just it just shuts down.
Yeah.
I just imagine screaming people in expensive suits or worse, endless rows of numbers flashing on a screen that look like they were written by a robot.
You are definitely not the only one who feels that way. I mean, Sophie and Jack actually start their whole series by addressing that exact feeling. They call it financial anxiety, or sometimes they use the term innumeracy phobia.
Numeracy phobia. Wow. That sounds like a serious medical condition. Like, sorry, I can't come to work today. I have a bad case of innumeracy.
It basically is. It's that fight or flight response you get when you see just a massive wall of jargon and math.
Yes, exactly.
Yeah. It feels like a secret code, right? Like it's designed to keep regular people out. Yeah. When you turn on the financial news and everything is flashing red and green, scrolling super fast across the bottom of the screen.
It doesn't feel inviting at all. It feels aggressive.
Completely.
It feels like I walked into a room where everyone is speaking a language I didn't study. But the goal of this deep dive today, and the reason I'm actually really excited about this, is that the source material promises to move us from that anxiety to something they call pizza ownership.
Pizza ownership. I love that term. It is the core metaphor of the whole series. And honestly, it's probably the best way I've ever heard this explained. It just completely demystifies what a stock actually is.
So let's get into that. Because usually when people try to define a stock, they say something really dry and boring, like, oh, it's a unit of capital.
Right.
But Sophie and Jack talk about Disney and pizza.
I do. So just imagine a massive company like Disney. It's worth billions and billions of dollars. In this metaphor, Disney isn't a corporation. It is a gigantic, multi-billion-dollar pizza.
The world's most expensive pepperoni pizza.
Exactly. Now, obviously, you, as a regular person, you cannot buy the whole pizza. It's way too expensive.
Right.
Even if you were super rich, buying the entire thing is practically impossible. So what does the company do? They slice that pizza into millions, sometimes billions of tiny, tiny slices.
Those slices, those are the stocks.
Correct. Those slices are shares. So when you open up an app and you buy one share of Disney, you aren't just buying some digital token or, betting on a random number.
Okay.
You are buying a literal slice of the company.
But see, this is where I start to get a little skeptical. Because if I buy a slice of actual pizza, I can eat it. It has real value to me. If I buy a tiny crumb of Disney, what do I actually have?
Right.
It feels, imaginary. Do I own the roller coasters? Do I own the Mickey Mouse costumes?
That is the crucial shift in mindset right there. You don't own the physical costume, but you own the rights to the profits that the costume generates.
Oh.
You are buying a certificate of ownership. You become a part owner of the actual buildings, the intellectual property, the employees' time. If the company makes money, your slice becomes more valuable.
So I'm not just betting on a horse race.
No, not at all. And that is the fundamental difference. You are actively participating in the business.
Okay, that actually helps a lot. But before we go deeper into the mechanics of buying and selling, I ran into some trouble with the vocabulary in the notes.
Sure.
We have the words stock, shares, and equity. In normal English, I feel like people just use these completely interchangeably. Like, I bought stock. I bought shares. Is there actually a difference, or are the finance people just trying to sound smart?
Yeah, a little bit of both, honestly. But there's a grammatical difference that is incredibly helpful for English learners to know.
Let's hear it.
Think of the word stock, kind of like the word furniture or fruit. It's the general category. It's almost always an uncountable noun.
So I would say I own Apple stock.
Right. Exactly. You wouldn't say I own 3 Apple stocks unless you meant you own stock in 3 completely different companies.
Right. That makes sense.
Now, shares are the specific units, like chairs or apples. So you say, I own 10 shares of Apple.
Got it. So stock is the broad concept, and shares are the actual things I can count.
Right.
What about equity? That's the one that always sounds the most intimidating to me.
Equity is the professional term for your total ownership value. It's basically used to talk about your stake in the game.
Oh.
So if you are at a fancy dinner party and you really want to sound sophisticated, you don't say, oh, I have some shares. You say, I have equity in that company.
I have equity. Oh, I'm definitely using that. It sounds like I should be wearing a monocle when I say it.
It definitely adds a certain flair.
But let's go back to the why. Why would a company slice up their pizza in the first place? If I baked the most delicious pizza in the world, or actually, let's say I started a bakery that makes incredible croissants.
Okay, croissant.
Why would I want to sell pieces of my amazing bakery to strangers? I want to keep all the profits for myself.
This is where the concept of the IPO comes in, the initial public offering. And the bakery example from the audio series is perfect here. Let's say your croissants are truly amazing.
Naturally. They're legendary.
Of course they are. You have one shop and there is a line around the block every single morning.
Okay.
So you want to expand. You want to build 100 new shops across the country. But building shops is really expensive. You need millions of dollars. Where do you get that cash?
Well, I go to the bank, right?
You could, but the bank is going to charge you interest. You have to pay them back every single month, whether you sell any croissants or not. That's a lot of risk, and the bank might just say no.
True. So I'm stuck.
Unless you go public. You decide to invite the public to become your partners. You say, hey, everyone, if you give me cash right now to build these new shops, I will give you a slice of the company.
So I get the cash completely debt-free, but I lose my total control over the business.
Exactly. You are trading ownership for capital. It's a massive decision. Before the IPO, it's your private bakery. You can do whatever you want. After the IPO, it's a public company. Now you have thousands of bosses to shareholders.
That makes total sense. It's a trade-off. I get the money I need to grow, but I have to share the pizza.
Right.
But this actually brings me to the thing my grandfather always used to say. He was very old school. He'd say, don't touch the stock market. It's just a big casino. It's gambling.
Yeah.
And honestly, when I look at how fast prices move up and down every day, it does feel like gambling. Is he wrong?
This is probably the most common myth that Sophie and Jack tackle, and the answer is, well, it depends on your timeline.
What do you mean by that?
If you look at the stock market over one day or even 1 week, your grandfather is absolutely right. It is random. Prices bounce around because of news, rumors, or just pure noise. It looks exactly like a slot machine.
Okay.
But, and this is a massive, but gambling is a zero-sum game with no underlying value. If you bet on a roulette wheel, the wheel doesn't actually produce anything.
It just spins.
Right, it just spins. But a stock is a productive asset. You are buying a piece of a company that actively makes cars or software or medicine.
Oh, I see.
So over the long term, and we are talking 5, 10, 20 years, the stock price isn't random anymore. It tracks how well that business actually performs in the real world.
So gambling is betting on blind luck, but investing is betting on human productivity.
Precisely. You are betting that humans will keep inventing new things and solving problems. That is a very different bet than putting your money on red or black at a casino.
Okay, I can definitely get behind that. But there is still one big hurdle for me, and I think for a lot of our listeners too, money.
The cost.
Yeah. I always assumed that to really invest, you need thousands and thousands of dollars. If a single share of Amazon is hundreds of dollars and I only have $50, I'm basically locked out of the system, right?
That used to be true. 10 years ago, you were totally locked out. But the landscape has completely changed with something called fractional shares.
Fractional, like fractions from math class.
Yes. The sources really emphasize this as a major game changer for accessibility. Now, brokers allow you to buy just a crumb of a share.
A crumb?
Yeah. So if a full share costs $3,000, you can say, hey, I only have $5 to invest today, and they will sell you 1/600th of that share.
Wow. So the entry barrier is basically zero now.
Basically zero. The barrier isn't money anymore, it's just knowledge. And this is important not just because it's cheap, but because it allows for diversification.
Right.
In the old days, if you had $100, you could maybe afford one stock. That's incredibly risky. If that one company fails, you lose everything.
Right. I dropped my only egg.
Exactly. But with fractional shares, you can take that same $100 and put $5 into 20 different companies. You can build a whole balanced portfolio with just pocket change.
That is actually really empowering. It means I don't have to wait until I'm rich to start. I can start right now while I'm still figuring things out.
And that is exactly the goal of the series, to get you started. But once you do start, you step into what they call the safari.
The safari. Oh, right. The animals. The bull and the bear.
The famous symbols of Wall Street.
I see these statues in movies all the time. But I always wondered, why these specific animals? Why not a lion and a shark?
Oh.
Or a rabbit and a turtle?
It actually comes down to the physical body language of how they attack. It's a really brilliant visual metaphor. Picture a bull. When a bull fights, what does it do?
It lowers its head, and then it thrusts its massive horns up into the air.
Exactly, it strikes up. So a bull market is when prices are going up. It represents optimism, growth, and investor confidence.
Horns up, market up. Got it. And the bear.
How does a bear swipe?
A bear stands up on its hind legs, and it swipes its heavy paws down.
Down. So a bear market is when prices are falling. It's usually defined as a drop of 20% or more. The bear literally forces the market down to the ground. It represents fear and pessimism.
That is surprisingly logical. I don't think I'll ever forget that now.
Yeah.
So if I say I'm bullish on tech, I'm saying I think the tech industry is going up.
You've got it. And here is where it gets really tricky, especially for our international listeners. There is a massive cultural trap involving the colors associated with these two animals.
Colors. You mean the red and green on the chart?
Yes. In the US, the UK, and most Western markets, what does the color green mean to you?
Well, green means go. Green means money. Green means the market is up. It's a bull market. And red means stop. Danger. Loss.
Right. So if you log into your account and your whole screen is green, you are very happy. But the sources point out that in many Asian markets, specifically places like China, Taiwan, and Japan, it is the complete opposite.
Wait, really? The complete opposite?
Yes. Think about it. In those cultures, what does the color red usually symbolize?
Oh, red is luck. It's prosperity, good fortune. Like New Year's envelopes are red, weddings are red.
Exactly. So in those specific stock markets, red means up. Red means prices are rising and everyone is making money. Green is actually the color for down.
That is wild. So just imagine an American investor landing in Tokyo, turning on the hotel TV, seeing a screen full of bright red numbers, and just having a total heart attack, thinking the global economy is crashing.
Meanwhile, everyone around them in Tokyo is celebrating a massive rally.
That is such a crucial detail. You really have to know the cultural context of the chart you're looking at.
You absolutely do. And speaking of looking at charts and panicking, let's talk about the language the daily news uses to describe these market movements, because they never just say, the market went down a little bit.
No, never. It's always so dramatic.
Sophie and Jack call these high-definition verbs.
High-definition verbs. I like that phrase.
If the market goes up, it doesn't just rise, it rallies, it soars, it surges.
Tech stocks soared today. It sounds like a superhero taking flight.
It does. And what about when it goes down?
Oh, that's when it gets genuinely scary. Stocks plummeted, the market tumbled, shares crashed.
Plummet. That is such a heavy, aggressive word. It sounds like a giant rock falling off a cliff.
It really does.
And the media uses these specific words on purpose to trigger an emotional response. And that leads us perfectly into the psychology of the market. The sources discuss a concept called volatility.
Which basically just means how bumpy the ride is.
Right. Right. It's the unpredictable, explosive movement of prices. And volatility triggers a very specific psychological bias in our brains called loss aversion.
Loss aversion. What exactly is that?
It's essentially a glitch in the human brain. Psychological research shows that the pain of losing money is about twice as intense as the pleasure of gaining the exact same amount.
Oh, I totally feel that. Actually, can I tell you a quick story about this?
Please do.
A few months ago, I found a crisp $20 bill in an old coat pocket. It's like, oh, nice. Free coffee for the week. I was happy for maybe, 3 minutes.
Sounds about right.
But then, literally the next week, I paid $20 for a sandwich at this new place. And it turned out to be terrible. And I actually dropped half of it on the sidewalk. I didn't even get to eat it.
Oh, no. The worst.
I was angry about that $20 for 3 entire days. I kept thinking about it. I wasted $20. The loss felt so much heavier than the gain from the week before.
That is loss aversion in action. And that exact feeling is why the stock market moves the way it does. There's a very famous saying in finance, the market takes the stairs up, but the elevator down.
The stairs up, but the elevator down. That is such a vivid image. Why does it happen like that?
Because of that fear, confidence builds very slowly. It takes months or even years for a stock to slowly climb the stairs step by step as the business grows and proves itself.
Right.
But fear is instant. When bad news hits or people see that high-definition word plummet on the news, the loss aversion kicks in. Everyone panics at the exact same moment.
They all rush for the exit at once.
Exactly. They basically cut the cable on the elevator, and that's why drops happen so incredibly fast.
So, if we know that our brains are naturally wired to freak out, and we know the market is absolutely going to take the elevator down sometimes, what is the actual strategy here? The sources outline 3 core actions: buy, sell, and hold.
And they argue that hold is actually the hardest action of all 3.
See, that sounds completely counterintuitive to me. Holding sounds like you're doing nothing. I'm just sitting on my hands. How's doing nothing hard?
It looks passive on the outside,
Yeah.
but internally, it is active emotional warfare. Just imagine you bought a slice of that Disney pizza we talked about, and suddenly the market plummets. Your screen is flashing red or green if you're in Tokyo.
Right.
You are losing money by the second. Your brain is screaming, stop the pain, sell, get off the elevator right now.
Right, just save whatever cash is left.
To hold in that exact moment requires what Warren Buffett calls temperament. You have to actively fight your own biology. You have to look at the elevator falling and say, I'm not getting off, because I know the building itself is still solid.
Wow. That takes some serious nerves of steel.
It really does. And this is exactly what separates investing from trading.
Okay, let's clarify that distinction right now, because I definitely used to think those 2 words meant the exact same thing.
Most people do, but they are totally different sports. It is all about your time horizon.
Okay.
Investing is like planting a tree. You put the seed in the ground, and you expect it to provide you with shade in 10 years. You don't go out and dig up the seed every single hour to see if it grew.
That would kill the tree.
Exactly. But trading is like playing a fast game of musical chairs. It's extremely short term. Traders are staring at screens, looking at tiny price changes over minutes, hours, or maybe days. They are trying to jump in and out constantly to make a quick profit.
So trading is high stress, high speed.
High stress, high speed, and very high risk. For a beginner, especially for someone suffering from that financial anxiety we talked about, trading is the absolute worst place to start. Investing is about patience.
I really like the tree metaphor. It makes the whole thing feel much calmer. But there's one last concept from the sources that I think really helps with the holding part we discussed. It's the critical difference between price and value.
Yes. This is usually the big aha moment for most people.
The sources use a department store metaphor that finally made this click for me.
It's a classic. Imagine you walk into a nice store and you see a beautiful leather jacket. It's $500. You love it. But that's just too much money. It's overvalued for your personal budget.
I walk away.
Right. But 2 weeks later, you come back to the mall. There's a massive clearance sale. That exact same jacket is now $200. Nothing about the physical jacket has changed. It's the same leather, the same zipper, only the price tag is different. What do?
I buy it immediately. It's a huge bargain. I'm thrilled.
You are excited because the price went down. But in the stock market, human beings act completely irrationally. When stock prices drop, when the market effectively goes on sale, people don't run in to buy. They run away screaming.
Because they think the store itself is on fire.
Exactly. They confuse the price with the value. A smart investor, what they call a value investor, looks at a market crash and says, oh, look, great companies are finally on sale.
That is such a hard mindset shift to make. To train yourself to see a scary market crash as a discount shopping day.
It is. And it requires overcoming one last psychological bias, which is called anchoring.
Anchoring. Like an anchor on a boat.
Yes. Our brains naturally get anchored to a specific number. If a stock was $100 yesterday and it drops to $80 today, we feel a deep sense of loss. We think it should be $100.
Right.
Or if it goes up to $150, we refuse to buy it because we are still anchored to that old price of $100. We think we missed the boat.
So we are basically just stuck living in the past.
Exactly. We
Right.
need to lift the anchor. We have to look at the reality of today. You have to ask, is this company worth this price right now? Forget what it cost last week.
This has been such a journey. We started with the sweating palms of financial anxiety. We realized that stocks are really just slices of a giant pizza. We learned to watch out for the red and green cultural trap. And we discovered that the real enemy isn't the market at all. It's our own psychology.
That is absolutely the ultimate takeaway. The stock market isn't a magical money machine, and it's definitely not a casino. It is just a marketplace of businesses. If you can control your fear, if you can tame the bear inside your own head, you can participate in that incredible growth.
I honestly feel much more empowered. I might not be ready to day trade on Wall Street anytime soon, but I can definitely buy a fractional slice of a pizza and just hold it.
And that's really all you need to do to start.
Before we wrap up, I want to throw a challenge out to you, the listener. We talked a lot today about time horizons and the idea of planting a tree for the long term.
The 5-year or 10-year view.
Exactly. So forget about money for a second. What is one thing in your life right now that you are investing in with a 5-year time horizon?
Oh, that's a really good question, because it doesn't have to be financial.
No, not at all. Is it your English skills? Is it your physical health? Is it a new relationship?
What are you holding through the hard times, through the daily volatility, because you truly believe in the future value?
Think about that. Because the mindset of a long-term investor applies to absolutely everything, not just the stock market.
That is a very powerful thought to leave on.
Thanks for joining us on this deep dive into the language of money. Hopefully the next time you turn on the news and hear the market plummeted, you won't panic. You'll just picture a bear on an elevator and go look for a discount jacket.
Ideally, yes.
See you next time.